Well, really, there are two things going on. One, what Brian's referring to also is that there's a breakdown in the relationship between domestic U.S. producers and investors, and they need a new social compact, and it's not there. The other thing that's happening is that oil is a register of risk. And very recently, it was measuring risk in the Persian Gulf. Oil got to $75 a barrel. There's still enormous risk there. On our count today, there are 537 tankers in and around the Persian Gulf. But what's changed is, of course, what's happened with China. And what is now registering is risk about a trade war, currency war, and a great slowing in the global economy, which is the real fear. And it's really this moving into a currency war situation is particularly alarming.
When you say that we need a new social compact between the companies and the oil price, I mean, play this out for us, because this disconnect is pretty large. But if you've been an energy investor, I mean, you've been absolutely creamed the last couple of years with production as high as it is. What needs to happen?
Well, it's an amazing story. The U.S. now the world's largest oil producer. But the other side of it is that investors are saying, hey, we want some return. We want some money back. We either want dividends or we want a share buyback. And I think the producers are going through a period the next few quarters of adjusting to a different kind of capital discipline, staying within budgets. And I think probably as a result of that, we're going to see, not probably, we will see a slowing in the growth of U.S. oil production. It will still grow, but not at that rate. But the other thing that's now hanging over everything is the global economy. We just did our new PMI, which we do with J.P. Morgan, and it shows that is at the lowest level since July 2012. So there are a lot of blinking lights about risk in the global economy, and that translates into weaker demand, and that too is weighing on the oil price and in particular on the oil companies.
Oh, sure. Brian, we saw even this morning the EIA saying that their estimate of how much we're going to produce this year has come down a little bit. You know, they're talking about production, they're talking about demand, you know, a little bit of a softening there. You're looking, I guess, there for those forces to help find a bottom in the market.
Yeah, there's two stories here. I think normally the stock and the oil story kind of go hand in hand, but to Dan's point, now they're not. I mean, oil is trading on the concerns about global economies, too much oil right now. The stocks are trading because investors are sick of it. Today, to your point, they haven't had any return in years.
Is this capitulation?
I don't know if it's capitulation, but two things happened very recently that have spooked people. Number one, Whiting Petroleum, these are mid-level producers, laying off 30% of its staff. We don't ever see layoffs in oil and gas. And Concho, who you mentioned in the intro, they had some very disappointing well results because they realized if you put a bunch of straws in the ground, too many, you're not going to get the results. And that's really the first crack, I guess, that we have seen where confidence in the fracking technology has actually been shaken.